Well, hi there. We're here again, Market Monday time, and gonna do this one a little different. Gonna start off a little different. I'm gonna start off this week with a bit of a confession. Gonna start off with a confession. I can't say the word. I'm going to a convention in a couple weeks for our company, but this week I'm gonna start off with a confession. But before I do, subscribe, hit that notification bell. You got, like, if you've been just casually following along with this market, I promise you, you want to subscribe. You want to start following this week to week, because what's going on right now is insane. And I want to start with the confession. The confession is, I put together all the data for Market Monday myself. I do it in the morning, and then I usually come just after lunch and typically shoot Market Mondays. And I look forward to like sitting down and pulling the data together, and I make a little PowerPoint that I use for myself that's just under the camera here. And I just go through the PowerPoint where I have some graphs and some notes that I build for myself. And then we've got just a wonderful team that then takes this and does the best they can to make me look presentable and puts the data together in a way that it makes sense for all of you. And for the last couple of weeks, I've really enjoyed the process of getting the data, putting it in, looking, I find myself going back to previous week's data just to see what's happening right now. It is dramatic. Like, it is truly dramatic. I got my real estate license, I think, in 2002, 2003. So like, I've had a license for, let's say, 23, maybe 24 years, something like that. And in my time that I've had my license, I've experienced what I would say is 4 major market shifts. The first one was shortly after I got in the business in 2004 and 2005, where the market just really caught fire. And that market caught fire from a buyer perspective. It was buyers coming into the market, and it was really fueled by no doc loans and that type of thing. And we know how that all turned out. But like, that was a demand-inspired run that was incredible. And that lasted until, I believe it was September of 2005, when Hurricane Katrina hit New Orleans. When that happened, our local market here crapped. Right? And what happened is that demand of buyers just is like somebody shut the faucet off and they stopped coming. And properties continue to come on the market at their normal pace. And then like, you turn around like 2 or 3 years later and you look, and we've got like 10 years worth of inventory on the market, right? And the market basically crashed, prices came down. So that was the second one, right? That was the second huge transformative market, is when Hurricane Katrina hit New Orleans, and over the process of the next couple of years, the market just crashed here locally, which culminated in the Great Recession with Lehman Brothers collapsing and the mortgage crisis. We all know about that, right? And that, happened in 2008. So like, from late 2005 to 2008, the market took a dive. Then COVID. Again, COVID was completely fueled by demand. People from states where they couldn't leave the house came here, got excited about the area, ended up moving here full time, and demand again created that run. And then the market slowed down because of inflation. Interest rates got increased, and that caused the market to cool down. So that was the 4th major market shift that in my 23, 24 year career that I've experienced. Well, folks, I can tell you, I can report to you today with great certainty that we are in the middle of another shift. And this is a shift from a slower market, a much slower market, to a market that we're gonna see, I think, off the charts appreciation. Like, I think the appreciation that we see this time will be greater than what happened during the pandemic, which was the greatest appreciated market that I've ever seen. Why do I say that? Well, this is the first one that I'll experience that is being driven not by demand, but by low inventory. You see, when things took off in 2004 and 2005, there was plenty of inventory on the market. And then the market crashed, and then a ton of inventory came on the market. When the market took off again at the pandemic, there was a tremendous amount of inventory on the market. Like over, I think it was 2,300 properties for sale when the pandemic, or the fall before the pandemic hit, right? 2,300 properties for sale. Well, right now we're sitting at, I think it's 800, and you'll see here in a minute, 800 and something properties, right? And so our sales activity is not super strong right now, but inventory is so low as it relates to our sales activity that we're really setting up a perfect storm, the likes of which I don't think we've experienced before. And I think, you know, I've said that I think the flashpoint's gonna come when the new Fed chair is put in place. That's what I thought, but I think the flashpoint is already here. And as we jump into these slides, I hope you can see what I see. So again, before we jump into the slides, subscribe, hit that notification bell. I hope I've given you a good reason today why you want to follow along every week. If you have an interest in property on Hilton Head Island, meaning you're interested in buying something, or you already own an interest in property here, you want to know what's going on with this, and I'm always going to give it to you straight. If the market is moving in a negative direction, I'm going to tell you. If it's moving in a positive direction, I'm going to tell you that too. That's one thing, I'll always tell the truth. So let's start off with new listings. 517 new listings have come on the market so far this year. That's 45 new ones over the last week. That is not normal for this time of year. We should be seeing many, many more properties come on the market this time of year. So last week we had 472, now we have 517. A year ago, we had 558. So 7.5% fewer listings coming on the market so far this year. Now, 7.5% doesn't sound like a huge number, but we came in with fewer listings on the market to start with. So the increase is on top of an already depressed inventory situation. So 558 a year ago, 517 now, 7.5% less. Look back to 2021, we're at 687. 687 listings had come on the market at this point on March 9th, 2021 versus 517, 25% fewer listings coming on the market at this point as opposed to 5 years ago, and already a tremendous amount less inventory to start with. So let's go to inventory. So this is a number, if you came to town this week and you wanted to look at property, on Hilton Head Island you have 837 properties to choose from. Okay? The crazy thing is, it went down from last week. We had 847 last week, 10 fewer. This is the time that inventory should be getting greater, not going down. Again, I'll say it again, we're already low inventory right now compared to what's normal. And the fact that it's going lower is why I started this conversation with you today the way that I did. Like, it is profound. A year ago, at this point, we had 1,077 listings versus 837 today. 22% fewer listings on the market today. Look back 5 years ago, we were at 1123. We're 26% less than where we were 5 years ago. This will be our first real run that's kicked off with low inventory. What's truly amazing as we start talking about pending sales is, despite this lower inventory, pending sales have now eclipsed last year. That's crazy. So far this year, 370 pending sales. We had 46 in the last week. So remember, previous slide, we brought on 45 new listings, we had 46 sales. So we sold one more than we brought on the market. So that's one less, right? Where did the other 9 come from? They expired, were taken off the market, those kind of things. So 324 new listings or pending sales as of last week, 370 this week, 46 over the past week. A year ago, we were at 362. So last week, the number was even, right? The pending sales right now versus a year ago was exactly equal. Now it's flopped. Now, up until last week, it was in the other direction. There had been more sales last year as compared to this year. Up until last week, that number became equal, and then here we go this week, it flip-flops. Now we've had more sales this year. So in the last year, 22% less inventory, but despite that, sales are up this year. Pending sales are up 2.2%. Amazing stuff. If we look back 5 years ago on March 9th, 2021, we're at 690 pending sales. So that's what's possible, right? But we need more inventory to hit a number like 690. But remember, price appreciation is the difference between the inventory and the sales, right? So it's the ratio that's going to push price. And that's why I'm saying we're about to see an appreciating market, the likes of which I don't think we've ever seen before. So comparing today at 370 versus 5 years ago, 46% fewer pendings today than 5 years ago. The closed sales, so this one hasn't flipped yet. We're a little bit behind last year, but the trend is with the pendings, and so we know what's coming. 296 closed sales so far this year. That's up 40 over the last week. A year ago, we were at 318, so we're now 6.9% less this year than that. But I'm going to guarantee in the next 4 to 6 weeks that closed sales eclipse last year's, and we'll have that higher closed sales this year versus last year. So 318 last year versus 296 now. Again, look back 5 years ago. At this point, we're 537 closed sales compared to the 296 right now. That's a 45% difference. Absorption rate, where you can really start to see the shift in the trend. And if you are here every week, you know coming around the beginning of the year, we were at 6.1 months. Just a couple months ago, we're at 4.8 now, the lowest that we've been in quite some time. 4.8 months is the current absorption rate. Last week it was at 5 months. A year ago we were at 6.3. So 1.5 months change in the absorption rate over the last year. Significant, significant, significant. And where were we 5 years ago? In the throes of the pandemic, we were at 3.5 months. It's amazing how quickly we're moving back to that. So again, absorption rate, 6 months is considered a neutral market, a market that doesn't favor the seller nor the buyer. They're kind of on equal ground. Less than 6 months is a seller's market, right? As you can imagine, if we're at 5.5 months, we're in a seller's market, but it's not that strong of the seller's market versus where we were in 2021 at 3.5 months. That was a very strong seller's market. Well, now we're at 4.8. And so the shift is, and it's happening and it's underway and it's significant, we are shifting very, very rapidly to a seller's market. But here's the thing, I don't think most sellers know it, and I don't think most buyers know it, right? This is historical data, meaning these are transactions that have happened as recently as over the last week, but it takes some time for that information to get disseminated. And there's not many good sources of this information locally. You can get it nationally 2 or 3 months after it happens, but getting your national real estate statistics is like getting the national weather when you decide what you're gonna wear and when you leave your house in the morning. It's all about the local numbers, right? This is the results of these changes and this swing in the market will be felt in the upcoming months. And by having this information now, it's like you have a crystal ball, whether you're a buyer or a seller. If you're a buyer, right, like the key is get the deal done because prices are gonna go through the roof in a very short period of time, right? If you're a seller, maybe don't negotiate so much because things are moving in your favor right now, right? That's absorption rate. Days on the market, you'll see it here as well. If absorption rate wasn't an indication of change being afoot, this should be. 77 days on the market is the current time that it takes for a property after it comes on the market to receive an offer and go under contract. Just last week, we were at 115 days, 38-day drop, right? Now that number is based on basically the first 6 months, first 9 weeks. We're 9-10 weeks into the year right now, right? So when we looked at it last week, we were at, let's say 8 weeks, and then we were at 115 was the average. We add 1 week and it drops 38 days to 77. That tells me that the transactions that closed in the last week had very, very, very low days on the market. It's the only way that we could see it change that profound in such a short period of time. right? Again, we're looking into our crystal ball here. We compare where we were a year ago, we were at 75. So 77 versus 75, right? A little bit more, 2.7% higher than last year. I expect that 77 is going to continue down. The only thing that's holding it up right now are the houses that have been on the market for a year or two. During this slowdown, those should get consumed here pretty quickly. And as those flush their way through the market, the only thing that will be selling is the stuff that comes on the market in the last week. It will sell almost instantly, right? As that happens, there creates more competition. Sellers say like, well, if it sold that quick, let me ask a little bit more money. So the next seller asks a little bit more money because their neighbor's house sold in a day with 4 offers, and then we have prices go through the roof. We all know how this plays out. But what I want to do is I want to show you the signs that, I mean, this is what's coming. Like every sign is there of what's coming. Compare days on the market right now of 77 with where we were 5 years ago. We were at 126, right? So that was 2021. Remember, it took us a while when the pandemic hit to consume all that inventory that had come on the market in 2018 and 2019 and 2020. That stuff had sat for years and years and years, and we had to clear that all out of the market before days on the market came down, and it did. I think days on the market at its lowest was in the 20s here on Hilton Island. So I expect that to come. How does it all affect property value? We had a gigantic jump this week. Last week, median sale price was $708,000. We went up $87,000 over the last week to $795,317. A year ago, we were at $757,583. So we're 5% higher, 757,000 versus 795,000 today, a 5% year-over-year increase. Again, those of you that have been watching me week after week, I've told you that that's about where we are, 5 or 6%. That number is going to skyrocket. That number is just going to skyrocket as sales continue at a regular pace with this super, super low inventory. Where were we in 2021? Median sale price $460,000. We're 73% higher than where we were. So the wrap up, inventory to me is like a golf score, the lower the better. So 22% down year over year on inventory. Closed sales 6.9% down. So we want that number to be higher if we want to see big appreciation. But know that that's coming. That 6.9% is shrinking and shrinking and shrinking. And based on what we see with the pending sales, 4 to 6 weeks, I think, maybe even sooner, because this is happening really fast, as these swings always do. They always happen a lot faster than you think they could, that change in market. So 6.9 today, prices up 5%, absorption rate down to now 4.8 months. Amazing, amazing stuff. If you're a seller, inventory is just driving everything right now. It's driving everything. To give you another example of how low inventory is right now, again, I think it was, I forget the number, 837 I think is what inventory was that I just reported to you. Looking over the last 10 years, right? And my MLS gives me good access to data for 10 years. But I can tell you if I could get the data for 30 years, the same statement would be true. Our 837 listings right now this time of year is the 3rd lowest inventory level that we've ever seen. Okay? The 2 years that were lower were during the middle of the pandemic, not before the pandemic started. They were in the middle of the pandemic after the sales already occurred, right? So we're at that number now before we see a surge. That's the main difference. Over the last 10 years, do you know what the average level of inventory is for this time of year in March? 1,570. That's the average. We're at 837. I know I'm being dramatic about it, but like folks, I've never seen anything like it. Median sale price bounced back up. Those of you that follow along know that over the last couple weeks, I've been reporting that it's come down, but I've said it's an anomaly. What we had is we had a February where the properties that sold in February were of a lower price point. And that caused the median sale price to come down, right? As we've gone into March, the median sale price for March is back in the 800s, and that's pulled that average number back up to a positive by about 6%. If you're a buyer, I don't know what else to say. I have been telling you for months that January and February were the greatest opportunity that you were going to have to buy a property for the best price that you could. that it was your best opportunity to negotiate a price with a seller who would be willing to negotiate. It's your best opportunity to buy a property without negotiating with the seller and 7 other buyers, right? Like last week was a better opportunity than this week. This week is going to be a better opportunity than next week. I can't express it enough. It's what's coming, right? And again, it's all because that typical surge of inventory that we have in the winter and the spring of every single year, it's just not happening. And so the leverage points that you've had as a buyer to negotiate with a seller to get a better deal, like as the inventory comes down, those leverage points continue to disappear and they're all gonna be gone. And I just remember during the height of the pandemic, how horrible it was to be a buyer, right? You had to go in and make an offer that was hundreds of thousands of dollars over the asking price. You couldn't get the property inspected. You couldn't have an appraisal contingency, like all of those things. Like that's what it was like during the height of the pandemic. And I coined a phrase within the office. I said, we have distressed buyers. Like we'd all heard the term distressed seller, meaning they were upside down on their mortgage or whatever and they needed to sell, right? But we had buyers that needed to buy. And the competition was so high that it was just excruciating. And I remember talking to sellers and sellers saying like, I'd like to sell my house right now during the height of the pandemic, but I'm very concerned that if I get a contract on my house, I won't be able to negotiate and buy anything. So people stay put, right? It's what's coming, and it's maybe gonna be worse than it was just a couple years ago with the pandemic. And when I say it's coming, like it's around, like up until the last couple weeks, I felt like we were gonna slowly, the market was gonna slowly shift towards a seller's market up until the point that Chairman Powell was relieved of his position with the Federal Reserve, and the new person took over because I feel very, very confident one of the first things that they're gonna do is cut interest rates, probably by 1/2 point, maybe by more. And that's gonna cause things to explode. Every time interest rates have come down a little bit, the market has really surged, right? And so I believe that's coming, and I believe it's coming because the administration wants to do everything that they can do to ensure that they win the midterms. And the best way to do that is to make everybody rich, right? So I've always felt like that's the point where the market is really gonna shift. That all changes. It has shifted. It has shifted, and it's already shifted, and it's got gigantic momentum, and this could be fuel on a fire, again, the likes of which I don't think we've ever experienced. Let's wrap it up with interest rates. They bumped up a little bit. The 30-year this week because of what's going on in Iran is up a little bit. Last week we were at 5.98 on the 30-year, and now it's at 6 even. A year ago we were at 6.63, so down 0.63 over the last year. The 15-year dropped a little bit. We were at 5.44 last week. It's down to 5.43 this week. We were at 5.79 just 1 year ago. So that's it. I know I totally geeked out. It's what I do. It's so interesting to me as a person that owns a home and some commercial property and all that stuff in the area. I hope it's interesting to you, and I hope you're back here next week. Thank you.